For investors who know how the stock market works, volatility creates opportunity. On today's episode of Total Return with Division 1 Finance, we're going to talk about some of the best moves to make when stocks are down. The goal is to combine the benefits of income and capital appreciation. Winning is not about what you do on the best days. It's about what you do on the worst ones. Episode 2 is your go-to guide to increasing your market returns by taking advantage of overselling and overreactions. Number 1, look for solid dividend payers. When stocks are down, dividend yields are higher. What may seem like a minor detail will actually lead to a major difference in returns. What you want to find is a consistent dividend-paying company who never misses or reduces their payout, or a company that simply consistently pays a high yield. This consistency at an even higher yield will reap great benefits over time. Growth companies who pay smaller dividends also pay higher yields, so keep this in mind. For example, a growth company that was paying 2% when the markets were up may be paying 2.5% when stocks are down. Over 5 years, that 2% yield will give you about a 10% return, but that 2.5% yield will give you 13%. Combining the dividend return with the stock returns, that additional 3% can mean the difference between beating the market and breaking even. Number 2, find defensive names. Defensive stocks can place you in a good position if markets continue to fall. In a recession, the stock market declines and defensive investors prosper. This is why defensive sectors should always be a part of your investment strategy. Consumer staples, utilities, or healthcare companies are all defensive. They are needed brands and services. For this reason, when the market is going through a downturn or the fear in the market is high, these stocks may outperform and also potentially provide additional stability to your portfolio. Defensive stocks also outperform when investors have concerns about economic growth. Number 3, buy beaten down blue chip stocks. Sometimes when markets are being blown up, some of the best stocks are seeing their worst days. Look for financially healthy billion-dollar brands that are likely to survive in a slower economy. There's no better time to buy stocks than when the largest companies in the world are hitting 52-week lows. Blue chips, much like defensive stocks, can help to add stability to your portfolio. A beaten down blue chip that pays a dividend can boost your returns for 5 to 10 years down the line. Number 4, look for growth potential. Finding companies that are likely to continue on their growth path as the market recovers is key. Look for companies who have seen lots of sales and earnings growth ahead of the bear market and research their business. If the company seems to have some sort of competitive advantage that will protect its revenue stream and their business model seems built to last, this is a buying opportunity. You also want to make sure the company is historically profitable. Check the balance sheet for positive retained earnings. Another key is to make sure the company is solvent and not over-leveraged. A debt-to-equity ratio below 1.5 is ideal when dealing with brands that are still trying to grow. Last but not least, be sure you are not paying too much for the company. One rule of thumb is to be sure you are not paying more than 10 times operating cash flow. For example, if the company is trading at $1 billion market cap, they should have at least $100 million in operating cash flows to match. Here's a little side note. Be prepared for the volatility. When stocks are up, make a list of names you want to buy when stocks are down. Also, don't forget to look for what you don't have, not what you already have a lot of. Remember, this could be your last opportunity for some time. Don't be a part of the herd. Let your portfolio be unique and free from other people's influence. Follow these 4 tips when stocks are down, and you will love the way your portfolio performs.